Hello, everyone. Welcome to Feedstuffs 365. I'm Sarah Muirhead. Joining us today to talk about what's happening in the beef sector, in the beef market, is Trey Freeman with Ever.Ag. Welcome, Trey. Thank you for joining us here today.
Good to be here, Sarah.
For those of you that are tuning in, we thank you for your time as well. And if you have any questions, feel free to post those in the chat area on the right of your screen. Joining us through social media, simply post your questions directly in those channels. So, Trey, last Friday, there was a big cattle on feed report. Bring us up to speed. What did that show, and what does that mean?
You bet. On feed and marketings came in very near last year's level, with on feed at 99.9% and marketings at 100.2%. Oklahoma came in with the largest increase in cattle on feed inventories, up 80,000 head, while Kansas inventories came in below 150,000 head for the fifth consecutive month. But placements, the always wily placements, were up 4.3% from a year ago. This was 5.8% above the average pre-report estimate. So what happened? Well, Texas placed 11% more, or 50,000 more cattle than a year ago, probably on account of winter grazing cattle coming into the yards. But also, if you look at a chart showing placements for Texas, they were tethered down in March, about 90,000 head lower in March than that of last year, and then 40,000 lower in April. Feeder cattle imports also may have played a role. Feeder imports from Mexico in the month of April were nearly 48,000 head higher than a year ago. And for the month of May, they were over 30,000 higher. Now, Nebraska placed 10% more, or 45,000 more head than a year ago. They came into the report already with 70,000 more placements through the first 4 months versus a year ago.
So what's this mean then for the market moving forward?
Well, the larger than expected placements, they'll impact fed cattle supplies this fall, and they'll work to subdue higher prices. Live cattle futures reflected this concern Monday, with October and the further deferred contracts struggling to tread water. But for the second week in a row, we saw packers step in late and drive up the cash market. Now, this is abnormal for packers to chase cattle like this in June. So what's going on? Why are they being so aggressive on the cash front? Well, the seasonal rally in wholesale beef prices that usually begins late March came late this year, not picking up until mid-May, and has edged higher ever since, when typically we see choice prices peak around June 1st and soften through July and into August. This continued strength in wholesale prices has helped support packer margins, resulting in those higher cash prices.
So you mentioned the continued strength in prices. What about in beef demand? We're seeing continued strength in beef demand. Why is that?
You bet. And just broadly speaking, going into 2023, consumers were facing inflation and a looming recession before year end. What did they do, though? They paid up for beef, taking wholesale beef prices to all-time highs. Now, although we did not match those historic highs made a year ago, wholesale beef prices remain firm. And look at retail prices. All fresh retail beef prices have risen from month to month for 15 of the last 18 months. And that's not just for beef prices, but pork and chicken retail prices have also been higher the last 3 months. Consumers are paying nearly 40% more for beef than they were pre-COVID.
So where's cash now? What are we looking at in specific terms?
Last week's 5-area cash price for steers was $194.84, up over $2 from the week prior. Interesting dynamic, though. The North is trading at a near $10 premium to the South. A premium in the North for this time of year, it's not unusual. However, $10 is historically high. Now, why is this? Well, calf marketings in the North have been delayed, all the while Texas and Oklahoma show lists have reached levels not seen since 2022. So moving forward into July, look for that premium to narrow as those calf feds come to the market in the North.
What about fed beef production? Any thoughts there?
Let's start with slaughter. Steer slaughter, it's down 1.8% for the first 23 weeks of this year. Heifer slaughter's down 1.5%. This has total fed slaughter down 1.7% for these first 23 weeks. Yet, fed beef production is actually up about 0.5% through the first 23 weeks versus last year. Why is this? Well, that would be dressed weights, as cattle feeders are able to obtain better margins by feeding longer on account of these cheap feed prices. Steers are averaging 920 pounds for the first 23 weeks of this year compared to 898 last year. That's 22 pounds over, or 2.4% higher. Heifers are averaging 843 pounds for the first 23 weeks of this year compared to 826 last year. So that's 17 pounds over. Now, looking at non-fed beef production, it's down 12.1%. For these first 23 weeks, of which cow slaughter is down 14.3%, while cow weights are up 10 pounds, and bull slaughter down 7.2%. But again, bull weights are up currently 29 pounds above year-ago levels. So together, this has total beef production down about 1.73% through these first 23 weeks. This follows a 4.9% reduction for the same time frame in 2023 from 2022.
Always like those cheap feed prices. Those are always a good thing for the cattle guys, for the livestock guys. What about herd rebuilding? What are you seeing going on out there?
So to rebuild, you have to have high calf prices and moisture. In previous market cycles, the year following the bottom of the beef cow herd is when calf prices tend to peak. The average 550-pound calf price in the U.S. is north of $3 a pound right now, and drought maps have improved considerably, besides some in Southwest Texas and Southwest Kansas. But the middle states, along with East Texas and Missouri, they've largely improved. However, it's only June, and rainfall in late summer and fall is still critical. So rains will be a large determinant to whether this herd bottoms out in 2025 and calf prices peak in 2026, or if the herd bottoms in 2026 and calf prices peak in 2027.
What about international trade? What are we seeing going on there?
The U.S. Is facing increasingly tough competition in the international beef trade as liquidation cycles are still well underway from across the globe. Also, the U.S. dollar remains strong, which not only hurts exports but also invites imports. Brazilian exports, for instance, continue their record tear so far in June. Their wholesale beef availability is up 11.6% versus year-ago levels, and they've had their largest production since 2018. Domestic buying interest is still low, and 19.45 million pounds are being exported daily. Now, for context, that pace 5 days a week amounts to about 19% of our weekly domestic U.S. beef production, and 3 to 4 times the volume we see weekly on the negotiated wholesale market. Now, in addition to Brazil, Australia is still in liquidation mode. On top of this, the Australians are in process of improving trade relationships with China, whereas China recently relisted 5 Australian beef plants that had been shut out for a few years now. So far for this year, and using an estimate for this month, total U.S. beef exports through June are expected to be down 4%, while imports are expected to be up 19%.
So is that really going to hit the market hard when you're talking 4%? Is that significant enough to give the market for the market to feel it?
Yes. So the 4% lower exports, this was expected. The big market to watch is China and China's economy, and them improving their trade relationships with Australia. What is that to do? What's to come for U.S.? I mean, they have been a large part of our export market over the last 3-4 years. So without them, it could certainly impact us more moving forward.
So what do you think? Can you give us a kind of a 2024 outlook in terms of, do you think the market's trending up, in good shape? I know a lot can change and there's a lot of variables, but any kind of gut feel at this point, what we're looking at for the rest of the year?
Well, beef demand, that's always the question mark. We can get fairly close on where our herd is, but beef demand is always the question. And what I've really liked over the last couple of weeks is this counter seasonal of wholesale beef demand moving higher. Typically, like I said earlier, we tend to move lower. There's such a lengthy gap from now into Labor Day weekend where beef demand, it typically softens up and we're moving higher. So I really like that. And look at these retail prices. I mean, they continue to move higher, but the consumer continues to pay.
Very good. I want to thank you for your time today, Trey Freeman of Ever.Ag. Thank you so much. And we'll be talking to you here next month and getting some additional insight. So appreciate your time.
All right. Thank you, Sarah.
Likewise, we appreciate all of you joining us and tuning in. A reminder, you can view this interview and others on Feedstuffs 365. For Feedstuffs, I'm Sarah Muirhead.